Let me paint you a picture. It's a Saturday morning. You open your brokerage app, coffee in hand, and you're looking at a sea of red. Tech is down, retail is down. Your travel stock you bought for the long term is down 14% in a week. But somewhere in that same market, on that exact same morning, a defense contractor just posted its best quarter in 30 years. An AI drone startup just landed a $20 billion Army contract. And a guy in Midland, Texas is pumping 6.6 million barrels of oil out of the ground every single day, quietly getting richer while everyone else panics. Here's the question that should be keeping you up at night, not why is the market falling? That's the wrong question. The right question is, why are some sectors absolutely printing money right now while others are bleeding out? And more importantly, are you in any of the right ones? Because we are living through what financial historians are going to look back on and call a war economy. And a war economy doesn't destroy wealth. It doesn't even slow it down. It just redirects it, violently. And if you don't understand where it's flowing, you will sit there watching red candles and wondering what you're doing wrong, while other investors are sitting on some of the most asymmetric gains of the decade. Today I'm going to show you the 2026 war economy map. 3 sectors that are genuinely skyrocketing right now, backed by real contracts, real revenue numbers, and structural tailwinds that aren't going away. And 2 sectors that are quietly getting crushed, not because of bad management, not because of bad luck, but because of forces that are completely outside their control. And if you own them, you need to understand exactly what you're sitting in. Let's start with something that'll put this whole thing in perspective. On January 7th of this year, President Trump made an announcement that barely got coverage outside of financial and defense circles. He said, and I'm paraphrasing, that the U.S. military budget for fiscal year 2027 should not be $1 trillion. It should be $1.5 trillion. Stop for a second and let that land. $1.5 trillion in a single year on defense. That would be a roughly 50% increase over the amount requested for fiscal year 2026. And if enacted, it would be the largest increase in defense spending since the Korean War, dwarfing even the increases during the War on Terror and the Reagan military buildup of the 1980s, whose biggest single-year increase was closer to 25%. But here's what most people miss. We're not even waiting for 2027. The fiscal year 2026 defense budget already crossed $1 trillion for the first time in American history. The FY 2026 national defense budget totals $1.01 trillion, a 13% increase over fiscal year 2025 enacted levels. And for the first time ever, the DoD dedicated a separate budget line specifically for autonomy and AI systems, totaling $13.4 billion. $13.4 billion just for AI and autonomous systems. In 1 year, that number is going to matter a lot in a few minutes when I talk about who's actually capturing that money. So we have a war economy running at full speed. We have a geopolitical environment that isn't calming down, the Middle East, Ukraine, Taiwan tensions, all of it. And we have an American government that has decided, in a very loud and very public way, that it is going to spend like it has never spent before on military capability. And when that much money starts moving, it creates winners and losers at a scale that most investors don't fully appreciate until it's too late. Let's talk about the winners first. Meet Marcus. Marcus is 41 years old. He works in finance in Chicago. He's a smart guy. He reads the news. He knows geopolitics are messy right now, but his portfolio is built around a classic 60-40 model, diversified, balanced, responsible. He has some tech, some consumer stocks, a little travel, a little retail. And for the past 18 months, he's been watching his returns stagnate while wondering why his strategy that worked so well from 2019 to 2022 just doesn't seem to be working anymore. Marcus knows defense is hot. He's heard it. But in his head, defense stocks are slow, boring dividend stocks for old guys. He thinks of a guy in a suit talking about fighter jets from 30 years ago. He doesn't realize that what's happening in defense right now is not your grandfather's arms race. This is something completely different, and it's creating 2 distinct lanes of wealth, the old guard and the new tech. Let's start with the old guard, because even they are doing something that would shock most people. Lockheed Martin is the world's largest pure-play defense contractor. In Q3 of 2025, they reported a record backlog of $179 billion. They recently won multi-year awards totaling $30 billion for missiles and helicopters, and management is confident in mid-single-digit growth through 2026. Now, to put $179 billion in backlog in perspective, that's not revenue they're chasing. That's revenue they've already locked in through signed government contracts. They just have to deliver it. That's one of the most powerful business models in the world. Imagine running a company where your customers sign contracts guaranteeing they'll buy from you for the next 5, 7, 10 years. That's what Lockheed has. That's what a record backlog means. Northrop Grumman is doing something even more striking. Northrop closed fiscal year 2025 with a record $95.7 billion backlog, free cash flow up 26% to $3.3 billion, and Q4 revenue growth of 9.6% to $11.7 billion. And their CEO, Kathy Warden, said something that should have been headline news for every investor. She called the current environment the most robust demand environment I have seen in my career. She has been in defense for decades. That quote doesn't happen when things are normal. That quote happens when we are at an inflection point. The combined backlogs of just Lockheed Martin, Northrop Grumman, and RTX sit north of $557 billion, $500 billion in locked-in future revenue, sitting on the books of 3 American companies, and NATO is only making it bigger. The 2025 Hague Summit completely reset the baseline, with NATO now targeting 5% of GDP on defense by 2035, 3.5% on core defense, and 1.5% on resilience infrastructure. That creates a decade-long structural tailwind that markets are only beginning to price in. But here's where it gets really interesting. Here's the part Marcus in Chicago is completely missing. The traditional defense primes, Lockheed, Northrop, General Dynamics, they're winning. But they're winning in the same way a big established restaurant chain wins during a food boom. Steady, predictable, profitable. But if you want to find the real growth, the kind of growth that turns a $10,000 investment into something that makes your jaw drop, you need to look at the new tech. The AI-driven defense companies, the ones that look less like Boeing and more like Google. Let me introduce you to Anduril. If you don't know that name yet, write it down. Anduril Industries was founded in 2017 by Palmer Luckey, the guy who built Oculus VR. His thesis was simple. American defense technology is stuck in the 1980s. The dude is buying 17-year-old software systems from companies that have no incentive to innovate because the contracts are guaranteed. What if you could bring Silicon Valley speed, real innovation, real AI, real autonomous systems, directly into the defense supply chain? The numbers say the answer is yes, in a very loud way. Anduril's revenue growth has been staggering. In 2022, they posted roughly $236 million. In 2023, $420 million, a 78% increase. In 2024, they crossed $1 billion, another 138% jump. Sacra estimates Anduril hit $2.1 billion in revenue in 2025, up 110% from the prior year. The company is projecting $4.3 billion in revenue for 2026, driven by their Arsenal 1 manufacturing facility scaling production in Ohio, with over $900 million in campus investment tied to that single facility alone. And the contracts keep coming. The Army Contracting Command recently awarded Anduril a potential $20 billion enterprise contract, providing a framework for counter-drone interoperability and foundational command and control capabilities. $20 billion for a company that was a startup less than a decade ago. Now, Anduril is currently private. You can't buy shares on a stock exchange today, but their valuation tells you everything about where smart money thinks this is going. Anduril's latest valuation sits at $30.5 billion following their $2.5 billion Series G round led by Founders Fund, up from $14 billion just a year earlier, a near doubling in less than 12 months. That's venture capital betting with enormous conviction on one direction. Defense tech is the next great sector for asymmetric returns. Then there's Palantir, and Palantir you can actually buy on the stock market, ticker PLTR, and the numbers here are almost hard to believe. For the fourth quarter of 2025, Palantir reported revenue of $1.41 billion, representing a 70% increase compared to the same period a year earlier. Their U.S. commercial business was a standout, growing 137% to $507 million. Their adjusted operating margin stood at 57%. 57% operating margin. That means for every dollar of revenue coming in, they're keeping 57 cents as operating profit. That is an extraordinary number for any company, let alone one growing at 70% year over year. And then on March 24th of this year, Palantir was confirmed as a core software provider to the U.S. Department of Defense, securing a foundational role for its Maven AI platform and multi-year government contracts. Palantir and Anduril also announced a collaboration on software for the U.S. Golden Dome Anti-Missile Shield initiative. The Golden Dome is a $175 billion project to build a comprehensive missile defense system over the United States, and Palantir just locked in a seat at that table. Palantir revised their 2026 revenue guidance upward to $7.2 billion, a software company, with $57.3 billion in government contracts building their revenue floor. That's what happens when the war economy meets Silicon Valley. Here's the mental model for understanding why these companies are so powerful right now. Think about the difference between building a tank and building the software that coordinates every tank, drone, satellite, and soldier on the battlefield simultaneously. Both are valuable, but one scales. Software is infinitely replicable. Palantir's Maven AI platform doesn't cost more to run for 500,000 soldiers than it does for 50,000. That's where the margin comes from. That's why a software company with zero physical inventory can post a 57% operating margin in the middle of a massive growth phase. The war economy's first winner is clear: defense, both the legacy primes riding the backlog wave and the new AI-driven tech layer capturing the highest margin growth. Now let's talk about winner number 2, and this one requires you to think about a map of Texas and New Mexico. The Permian Basin. If you've never heard that name before, let me reframe it for you. The Permian Basin is essentially an underground ocean of oil, sitting roughly 600 meters beneath the desert of West Texas and southeastern New Mexico. It is, without exaggeration, the most productive oil region on Earth right now, and the producers operating there are sitting on one of the most durable revenue engines of the 2026 war economy. Here's why this matters. In 2025, the Permian region produced more crude oil than any other region in the United States, accounting for 48% of total U.S. crude oil production. Production grew by 280,000 barrels per day to reach 6.6 million barrels per day, and the U.S. as a whole set a new annual production record of 13.6 million barrels per day. U.S. 13.6 million barrels per day. The United States is producing more oil than it ever has in its history, and the Permian is the engine making that happen. Now, I want you to understand why this is a war economy play specifically, because on the surface, it might seem like a straightforward energy story, but there's a geopolitical layer here that most people completely miss. When global conflict disrupts oil supply chains, when Middle East tensions spike, when shipping routes through the Strait of Hormuz become uncertain, when sanctions on Russia and Iran pull supply out of the global market, the countries that are energy independent become price setters. The countries that are energy dependent become price takers. They are at the mercy of whoever still has supply. The United States made a deliberate bet on energy independence, and the Permian Basin is the physical, geological proof of that bet paying off. When global oil supply gets constrained by conflict, U.S. domestic producers don't just survive, they gain pricing power. They become the marginal supplier to a world that's scrambling for barrels. And in a war economy, that's exactly the position you want to be in. The Permian Basin currently accounts for roughly 40% of U.S. oil production, with projections suggesting that figure could reach 70% by 2040 as other basins mature, and the Permian continues to demonstrate geological superiority. Now I want to be honest with you here, because this story has some nuance. The EIA forecasts that oil prices in 2026 could be a low point for the cycle, which does create headwinds for raw profit margins. The West Texas Intermediate crude price is forecast to fall from its 2025 average of $65 per barrel toward $52 in 2026. Permian break-even prices for the two major basins, Midland and Delaware, are around $61 to $62 per barrel, which means some producers are operating near break-even at current price forecasts. U.S. But here's what you have to understand about how this plays in a war economy scenario. Those price projections were made before the latest round of Middle East escalation, before oil briefly touched $100 a barrel in March 2026, before jet fuel doubled in price in a week. Jet fuel prices have roughly doubled since late February 2026, driven by geopolitical tensions in the Middle East that have disrupted oil supplies through key routes like the Strait of Hormuz. That is not a price forecast environment, that is a supply shock. And the companies who sit on 6.6 million barrels of daily production capacity in a politically stable U.S. state, with pipelines already in the ground and workers already on site, are the ones who benefit most when that kind of price shock hits. The efficient Permian producers, the ones with the lowest cost structures, the best pipeline access, and the most hedged operations, those are the ones positioned to turn a supply shock into a windfall. Companies like Permian Resources, Pioneer's successor operations absorbed into Exxon Diamondback Energy, these are the names in the middle of the geological lottery that is the Permian Basin. So that's two sectors skyrocketing: AI-powered defense tech and traditional defense primes on one side, domestic energy independence on the other. Now, I need to talk to you about the sectors that are quietly getting destroyed, because this is where I see a lot of individual investors make the most painful mistakes. Let me tell you about Priya. Priya is 34, lives in Atlanta, works in marketing. She's a disciplined saver. She has a Roth IRA she's been contributing to for 7 years. She bought airline stocks 2 years ago because she read an article that said post-pandemic travel recovery was just getting started. The logic made sense. People were traveling again. Airlines had pricing power. The trade worked for a while. Then 2026 happened. The airline industry is caught in a classic margin squeeze, and it's not a temporary one. On March 12th of 2026, United Airlines saw its share price crater by 33% in a single trading session. The collapse was triggered by Brent crude oil breaching the $100 per barrel threshold, which effectively evaporated the profit margins of major carriers. As jet fuel prices surged nearly 60% in a week, investors scrambled to reevaluate the viability of high-growth strategies in an environment defined by persistent inflation and runaway energy costs. 33% in one day, that is a catastrophic single-day loss, and the mechanism causing it is crystal clear when you understand how airlines actually make money. Fuel is not just a cost for airlines. Fuel is the cost. Fuel has historically accounted for roughly a quarter to nearly a third of an airline's entire cost base. When crude prices lurch higher in a matter of days, carriers have limited ability to reprice tickets already sold, leaving them completely exposed in the short term. Think about that for a second. Imagine you own a restaurant and your ingredient costs triple overnight, but every table you have booked for the next 6 months already paid a fixed price for their meal. You cannot raise prices on them retroactively. You absorb the loss. That's exactly what happens to airlines when oil spikes. The tickets are already sold, the fuel bills are coming in at the new price, and the margin gets absolutely crushed. Airlines are now responding by hiking ticket prices and adjusting capacity, but they must balance these moves carefully to avoid alienating price-sensitive passengers amid broader economic pressures from rising gasoline costs. And that's the real trap, because the passengers who might absorb a 20% fare increase are the same passengers who are now spending $200 more a month on gasoline to fill their tank. Current projections indicate that airfares could be 5 to 10% higher than previous expectations through 2026 and 2027, with the potential for sharper increases in specific markets if fuel prices remain elevated. So the airline industry is caught between a rock and a hard place. They need to raise prices to survive the fuel cost surge, but raising prices risks demand destruction from customers who are already financially stretched. It is genuinely one of the worst business positions you can be in. Now let's get to the sector that is perhaps the most underappreciated casualty of the war economy: consumer discretionary. And I'm going to use a simple analogy that I think will make this click instantly. Imagine the average American household budget as a glass of water. Every month, the same amount of water flows in the paycheck, and that water fills up and gets poured into different cups: housing, food, healthcare, savings, and then at the very end, what's left goes into what economists call discretionary spending. The fun stuff: the new iPhone, the vacation, the streaming services, the new TV, the clothes you didn't need but bought anyway. Now imagine you punch a hole in the bottom of that glass. Every month, before the water even reaches the discretionary cups, it's draining out through that hole. That hole is energy costs, and right now, that hole is getting bigger. Consumer sentiment fell 29% between January and May of 2025 amid concerns about future inflation. And even after rebounding, it remained 11% below the same period of 2024. Real spending on air travel was down 3% in the second quarter of 2025 compared to the same quarter a year earlier. That's not recession-level data, that's just squeeze-level data. The middle of the squeeze, where people are not broke but they're definitely cutting back. They're choosing the staycation over the European trip. They're delaying the new laptop. They're skipping the concert tickets. Every dollar that goes into the gas tank is a dollar that doesn't go to Apple, Amazon, Netflix, or Disney. And this is not a philosophical concern. This shows up directly in the earnings of consumer discretionary companies. When oil prices spike, the first thing that gets cut in the household budget is exactly the sector that these companies serve. It is as reliable as gravity. It happened in 2008. It happened in 2011. It happened again in 2022, and we are watching it happen again right now. The sticker shock at the gas pump, hitting $5, $6, sometimes $7 a gallon depending on where you live, is not just an inconvenience. It is a direct tax on consumer spending power, and it flows in one direction, away from discretionary sectors and into the pockets of the energy producers. The money doesn't disappear, it just moves. From Amazon's earnings to Permian Basin cash flow statements, from Netflix subscriber growth to Chevron dividends. The war economy doesn't destroy spending, it redirects it. So let me pull this all together into something you can actually use, because my job isn't just to explain what's happening. My job is to help you think about what to do about it. Here's the framework I want you to walk away with today. In a war economy, money flows toward two things: necessity and lethality. Necessity means the things a modern military civilization cannot function without: energy, logistics, domestic production. Lethality means the things that actually win conflicts: advanced weapon systems, AI-driven command and control, autonomous platforms, precision munitions. Everything else, the things that are nice to have when times are good, when people have surplus income, when geopolitics is quiet, those get squeezed. The actionable takeaway is not sell everything in consumer discretionary and airlines and throw it all into defense tomorrow. That's not a plan, that's a reaction. And reactive investing is how you buy high and sell low. The real move is understanding the structural shift and positioning accordingly over time. For defense exposure, the traditional primes, Lockheed, Northrop, RTX, General Dynamics, offer predictable contract-backed growth with real dividend income. Sitting on a combined backlog north of $557 billion, they offer a level of revenue visibility that is almost non-existent in other sectors. If you want growth with less volatility, this is where you start. For the higher-octane bet, Palantir, which is publicly traded, sits at the intersection of AI and national security. It is not cheap on a traditional valuation basis, but the revenue trajectory, 70% year-over-year growth, 57% operating margins, locked-in government contracts, and a direct seat at the Golden Dome initiative, tells a story that pure valuation metrics don't fully capture. Understanding the thesis matters more than just looking at the price-to-earnings ratio. For energy, domestic producers with Permian Basin exposure, strong hedge books, and low cost structures are positioned to benefit from any supply shock scenario. The risk here is that oil prices stay low, which hurts margins. But the asymmetric upside if conflict escalates and global supply tightens is significant. Owning some exposure here is not speculation. It's hedging your portfolio against the exact scenario that destroys everything else. For consumer discretionary and airlines, I'm not telling you to panic sell. If you hold these positions, understand what you own and why you own it. These sectors will recover when energy prices stabilize and consumer confidence returns. But timing that recovery is genuinely difficult right now, and the near-term headwinds are real. Here's the bigger thing I want to leave you with. Most people look at a period like this one: geopolitical tension, rising energy costs, a war economy, and they see chaos. They see uncertainty. They freeze. They do nothing. Or worse, they panic. They sell at the bottom of the cycle, get out of the market entirely, watch the recovery happen without them, and then buy back in at the top. The investors who build real wealth don't see chaos. They see a map. They see money moving. They trace the flow. They ask, if a government is about to spend $1.5 trillion on defense in a single year, who captures that? If energy prices are being disrupted by geopolitics, which domestic producer is positioned best? If consumer spending is getting squeezed, which sectors are most exposed and which are most insulated? These are not complicated questions. They're disciplined questions. And asking them, calmly, consistently, with an understanding of the structural forces at work, is exactly what separates the investors who come out of a war economy wealthier than when they went in, from the ones who just survive it. The map is right here. The sectors are identified. The winners are running. The losers are showing you the warning signs right now, in real time, in the earnings reports and the stock price movements and the fuel cost data. The only question is whether you use the map. So what's your next move?